Hello there. To those seeking the truth beyond the price in the noisy, complex, and often misleading world of finance, welcome. Today we will talk about that deep loneliness in front of the screen, those stomach cramps at the moment of decision-making, and that complex language the market whispers to you. But while doing this, we won't use the modern, flashing tools everyone uses today. Instead, we will use a treasure map taken down from dusty shelves from a century ago, one that still shines brightly when you blow the dust off it. If you are ready, turn down the noise of the outside world. Because we are embarking on a journey into the mind of Richard Wyckoff, that is, into the footprints of smart money. When you look at those bright, high-resolution screens sitting in front of you right now, at those colorful charts updating at 1,000th of a second, everything looks so clean, doesn't it? How organized, how systematic. Candlesticks lined up with military precision. Moving averages following the price like a loyal shadow. Down below, oscillators screaming at you with red and green zones. Look, this is overbought. Sell immediately. Watch out. This is oversold. Buy immediately. This comfort zone provided by modern technology creates a dangerous illusion, as if the market itself is very orderly, as if everything exists within mathematical certainty. However, let's rewind the calendar pages a bit, quite a bit back. I want you to imagine the early 1900s, the era when Richard Wyckoff developed this method and unraveled the genetics of the market stitch by stitch. Back then, you didn't have an RSI indicator at your fingertips. There were no alarms to warn you, no automatic stop-loss orders, or AI-powered software offering you ready-made strategies. Everything was instantaneous, everything was raw, and everything flowed in a wild manner. Visualize those smoke-filled old trading halls. The prices clicking onto paper strips coming out of ticker tape machines, the piles those paper strips formed on the floor, the noise, the deafening shouts, the smell of sweat, and the most vulnerable state of human psychology. A complete chaos where fear and greed intertwined. It was right in the middle of this chaos, this noise and uncertainty, that Richard D. Wyckoff realized that tremendous truth which remains valid even 100 years later. Wyckoff saw this. The market is not actually complex, it's just that most people look at it from the wrong window. At that time, just like today, everyone was asking this question in panic. What will the price be tomorrow? Will we go up? Will we go down? Wyckoff pushed this question aside with the back of his hand, because this was the question of a gambler, not a trader. Instead, he asked this much more vital, much more fundamental question that smelled of engineering precision. What is happening deep inside the market right at this second, and what does this movement I see mean mathematically? In this broadcast, we will talk not only about Wyckoff's philosophy, but also about the measurable, clear, and rule-based technical analysis structure known in the literature as trade secrets. We will leave aside trying to predict the market or fortune-telling. We will learn to solve it like a math formula. To truly internalize Wyckoff's approach and look at the market through his glasses, there is a very powerful metaphor we need to etch into our minds: the concept of the composite man. Wyckoff gives us very critical advice here. Do not view all those big players, massive banks, hedge funds, market makers, and whales in the market as independent, randomly moving parts. This is a huge mistake. Think of them as a single organism, a single mind, a massive operator. Analyze the market as if a single person sitting behind the curtain is managing it. This composite man, the secret master of the market, is not actually your enemy. On the contrary, if you learn to read his footprints and hear his breathing, he is your greatest guide in this dark forest. So, what does this massive operator, this composite man, do? How does he think? Actually, he operates with a simple but ruthless trading logic. And while doing this, he uses the psychology of the masses, that is, your psychology, like a weapon. While the small investor sells in fear while headlines like "We are ruined," "Finished," "This market will go to zero" are thrown around, he collects goods silently, calmly, and patiently. In other words, when goods are cheap, when no one looks at them, essentially when there is blood in the streets, he is a buyer. Conversely, when everyone is buying with enthusiasm, when rocket emojis are flying in the air on social media, when chants of "We are going to the moon" are shouted, he distributes what he holds. That is, he moves in exact opposition to the emotions of the masses. But he is very insidious and careful while doing this. He never wants to leave a trace. He doesn't raise the price sharply while buying so that his own cost doesn't increase. He doesn't drop the price immediately while selling so that he can unload the goods at the highest possible price. The power we call smart money in the modern financial world today is actually the very entity Wyckoff defined 100 years ago. Then the real question before us is, how will we track the footprints of this invisible giant, this operator trying to walk in the snow without leaving a trace? Wyckoff's first axiom, the constitution of this business, is very clear. The market is read only by its own action. Do you know what this means? News, company balance sheets, CEO statements, rumors, or comments on forums are not analysis inputs. These are often just noise, baits thrown to distract you. Wyckoff puts a single data set, a single reality on the table: price, volume, and time. His technical analysis is actually a multiplication operation: price times volume times time. If these three are not in mathematical harmony with each other, the signal you see on the screen is invalid, it is fake. So how do we measure this harmony? This is where Wyckoff's most numerical, most critical law comes into play: effort versus result. Wyckoff doesn't want relative interpretations or emotional approaches here. He wants a direct, concrete comparison. The formula is simple. Volume is the effort spent. Think of a car. Volume is the fuel going to the engine, how much the gas pedal is pressed. The distance the price travels is the path the vehicle covers, that is, the result obtained. Let's concretize this with Wyckoff's own logic by visualizing a chart in your mind. Let's say in a previous upward wave, the price increased by 3%, and did this with an average, reasonable volume. Everything looks normal. Now you look at the chart again, a new upward wave is coming. There is a serious increase in volume bars, 2 or even 3 times the transaction of the previous volume is turning. The market is on fire, everyone is trading, so the engine is screaming, the effort is tremendous. But you look at the price, that candlestick has remained tiny. The price has stalled or only risen by 0.5%. Right at this point, while the novice investor thinks volume is increasing, so there is interest, the price will fly, the Wyckoff trader stops. He doesn't ask, "I wonder what will happen." He gives his final verdict: this is a weakness. Why? Because despite the massive effort spent, despite that fuel burned, the result obtained has diminished. The engine is screaming, but the car isn't moving. Why isn't it moving? Because the car is stuck in the mud. That mud is the hidden sellers. This situation proves that that volume is not an appetite for buying, but on the contrary, that those big players, taking advantage of the rise, are selling with passive orders. This is an absorption process. The energy of the buyers is being absorbed by the sellers. What we call divergence in modern technical analysis today is actually this simple discovery of Wyckoff. Let's take this rule a bit further. There is a strict rule mentioned in Wyckoff's tape reading notes. If volume is increasing but price isn't going anywhere, there is supply there. This is not an interpretation, it is a determination. If the price cannot advance but volume is coming in high, smart money is leaving the goods in the lap of the retailer. When you see this structure, it doesn't matter how good the news is or how wonderful the project is. The technical truth is the presence of selling. So, what is happening in the big picture? Markets do not move randomly, they are in a cycle. Wyckoff divides these cycles into 4 main phases: accumulation, markup, distribution, and markdown. Everything starts with accumulation, that silent and patient gathering process. Big players are incredibly patient when collecting an asset from the bottom. They never want the price to shoot up early. That's why they trap the price in a certain horizontal band and wear out the investor. Wyckoff sees this horizontal process as a cause. The law of cause and effect comes into play here. The longer an asset is stuck horizontally, the more energy it accumulates. The greater the trend it creates at the moment of explosion. So for a Wyckoff trader, there is no boring sideways market. There is a preparation phase where energy is stored. The most profitable moment of this process is the event we call the spring. Most people know this as a bear trap. But a spring is not a random wick. For a movement to be a spring, the price breaks support, volume increases with panic selling, but the price cannot stay down and quickly returns above the support, that is, into the range. But the job doesn't end here. The Wyckoff trader doesn't buy immediately, because the rule is, a successful test is one with decreased volume. This brings us to the concept of the test. The price comes back to check that bottom level again. It looks to see, are there still sellers? Wyckoff only looks at the volume here. If volume has dried up during this return, meaning there are no sellers left, the transaction is complete. If the volume hasn't dried up, the selling isn't over, and that trade is not entered. It is not the shape of the pattern that protects you, but the confirmation of volume. Let's say the test was successful and the rise, that is, the markup, began. How do we know the trend is healthy? While the price is making a new high, volume should increase, demand should remain alive. While the price is pulling back, volume must definitely drop. If the price is making a new high but volume is falling, Wyckoff warns, the trend is nearing the end. This distinction is a vital nuance that protects you from buying goods at the top at the peak of enthusiasm, and the end of every party, the distribution phase. It is the most insidious place in the market because the news is great. Everyone is talking about that stock, but the Wyckoff trader looks at the math. The price struggles to go up, volume breaks records, but the price just can't break away. Effort maximum, result minimum. Wyckoff says, the public buys after the rise, sells after the fall. The operator does the opposite. There is no point in asking, why did it fall, in the subsequent decline phase because the cause was already formed at the top. The market owes you nothing. What matters is not being stubborn with the market, but reading the operator's intention. To wrap up, my friends, there are no magic wands or secret parameters in the Wyckoff method. The real secret is reading the divergence between volume and price within context. Wyckoff doesn't tell you draw this line, buy from here. He makes you question, price is falling, but why is there no selling volume? Is this drop fake? Or price is rising, but why is it struggling so much? Is there offloading going on? The answers you give to these questions should not be feelings, but as clear and measurable as the height of the bars on the chart. Also remember, this is not just a chart reading method, but also a character training. Wyckoff says, if there is no discipline, knowledge is worthless. Trading with the fear of missing out is not the method's fault, but yours. Waiting in cash is also a position. A hunter doesn't shoot at every bush rustle he sees in the forest. He waits for the right moment. Today, technology may have changed. Bots may be making thousands of trades in milliseconds. However, there is only one thing that hasn't changed, that has remained the same for 100 years. Human psychology and the fact that big money, that is, that composite man, still needs liquidity, meaning you, to open and close positions. Accumulation is still done secretly. Distribution is still presented with the most enthusiastic news. Starting tomorrow, look at your charts, those colorful screens, with this eye. Be interested not just in what the price is, but in how much fuel was spent to get to that price. That is, be interested in the volume. Listen to the whisper of volume. Because in the market, price can lie, it can deceive you, but volume never lies. Wyckoff's legacy and true market literacy are hidden in this honesty. See you in the next episode. May your profits be plentiful and your volume be real. Goodbye.